Now, economists and investment banking professionals have asked the Nigerian government to do more in the areas of fiscal realism, trade policy, food sustainability, and support for small and medium enterprises. These were some of the suggestions expressed at the quarterly economic discourse held today in Lagos, organized by Kari Asset Management. That forum looks to explore how businesses and investors can thrive in a volatile global and domestic environment. Let's take a listen.
The insecurity is a clear challenge to any sector of the economy, not just tourism, not just agriculture. Of course, we've seen the impact of insecurity in the agricultural sector. We've seen farmers in the food belt of this country, that's Benue, Plateau, Taraba, displaced. In fact, as we speak today, if you look at food inflation in the country in the month of May, food inflation was highest in Benue. And Benue used to be the major point where we produce food and distribute this country. So clearly, insecurity is a challenge to food production. Insecurity is a challenge to tourism because the tourists must be comfortable that they will be safe. And that's why I think it was Jude that spoke on insecurity. So the issue of insecurity challenge cannot be overemphasized. The government needs to do everything we have to. I mean, I was talking to somebody last week, and he said to me that when his in-laws came, in-laws are Europeans, that they drove to Yankari Game Reserve. They went to Spain, and those in-laws have been asking to come back and make an offer to Yankari Game Reserve. So the government has to do a lot. So it's going to be, it's a drawback. It's a limiting factor. The insecurity is a limiting factor to developing the tourism industry as well as the small agricultural sector.
There are huge opportunities for many businesses in Africa. And what would I tell an investor to look at? First and foremost, try and understand the political ideology of whatever country you're going to, the ruling class. And what do I mean? If you look at Nigeria today, and you look at us from the era of democracy, 1999, we've had various political ideology. But you'll find out that in the periods where we had pro-market political ideology, Nigeria as a country where various sectors have thrived. But in periods where we have the statist economic view, those are the periods that there have been dissatisfaction in terms of various impacts on various sectors. So when I say to an investor who is going into any market, whether it's a small and medium enterprise investor, I will say to you, first you need to understand the political ideology of the ruling class. Secondly, political stability in those markets. And a critical factor is the long-term inflation rate. Now, when we decided to branch out to other African countries, one of the parameters we looked at is the long-term inflation rate. And why is it important? By looking at inflation, you will see the impact on various macroeconomic prices, whether it's the interest rate, whether it's the exchange rate. Now, when we decided to go into East Africa, what was the main driver? We look at those markets and we realize that the inflation rate was between 3 to 6% in terms of long-term inflation rate. If you look at Nigeria today, historically Nigeria used to be 12, but if you look at Nigeria today, we're looking at a high of 17-18%, and it makes it difficult to invest. Why? You're having to contend with high interest rates, which is what we're seeing now, exchange volatility, which is now been tapered. So you find out that you have to go and diversify, which is what Johnson was talking about. Go into other markets whereby the prices, the interest rates, the exchange, there's more stability.
The first quarter of this year, the economy witnessed relative stability, on the back of the reforms. And that has had the effect of reducing our country risk and also reducing Nigerians' risk premium, if you understand what I mean. The risk premium is the difference between your yield, your sovereign bond yield, like the Euro bond yield, and the yield of the US Treasury 10-year bond. Today, the US Treasury 10-year bond is around 4.48%. And if you look at even the Euro bond that will be maturing in November, we have 1.1 billion Euro bond that mature in November. The yield has come down to as low as 5%, so meaning the price has gone up. So the risk premium, has narrowed considerably, and that's on the back of, what has happened. So you can say to a large extent again, confidence in the economy, has, largely improved. Just as has been observed too, the cost of borrowing is very high. MPR at 27.5% is still very high, and the IMF recent report is saying that the central bank MPC should continue to tighten monetary policy. If you read that report, that it should continue to tighten monetary policy in order to maintain a positive real interest rate. Okay, today inflation is at 22.9. And MPR at 27.5, so you have a positive real interest rate. So the IMF is saying maintain that positive real interest because that's what is attracting the investors. But again, locally, we know, just as Johnson mentioned, it's becoming difficult, and he also mentioned it, Dr. Yusuf, the cost of borrowing. So for me, while it makes a lot of sense to have the Fisher effect, maintain positive real interest rate, it's also important to see how we can get SMEs access credit, through other means, maybe through our DFIs, strengthen our development finance institutions, the Bank of Industry, and so on, so that they can also lend to these SMEs, given the fact that the cost of borrowing is high.
We are not addressing enough the role of trade policy in fixing this economy. There is too much emphasis on FX, on interest rates, on FDI, on portfolio flows. But when we talk about the real economy, trade policy is extremely very critical because it affects the cost of inputs. So when you have a situation where the customer is under pressure to meet targets, revenue targets, and you have an economy where quite a number of the inputs you require to produce in the economy are also imported, those things create a lot of contradiction, and it puts a lot of pressure on those who are in the real sector of the economy. So I think we need to look more critically at how we can deploy our trade policy instruments to be able to support the real sector of the economy so that they can cope with some of these headwinds that we are dealing with. And we need to be a lot more sensitive about the social context in which we manage the economy. It's extremely important because we are in an economy, we are dealing with people. So if there is such a high level of social discontent about the economy, we need to be very careful. We need to look at it critically and how we can take some deliberate policies outside the conventional.